Well, a warm welcome, everyone, and welcome to the Solace Financial and Economic and Investment Snapshot for February 2025. There's a lot to unpack, so let's get started. First up, US tariff concerns continue to weigh on global investor sentiment. Softer economic data and stable inflation have strengthened expectations for a US rate cut this year. Meanwhile, in Australia, a solid earnings season and the first cash rate reduction since 2020 did little to lift the share market, but economic indicators suggest a more supportive outlook for the Australian economy. Global share markets mostly retreated from all-time highs in February. The MSCI World Index dipped by 0.7%, driven by weakness in US large-cap companies. The Australian share market also flattened despite better-than-expected reporting season. The Trump administration's trade and tariff rhetoric increased market volatility, while softer economic data lifted bond markets. In Australia, the S&P ASX All Ordinaries dropped 4%, erasing most year-to-date gains. The sell-off was broad-based, with the S&P ASX Mid-Cap 50 and Small Ordinaries falling 4.7 and 2.8 respectively. Defensive sectors provided some support, with utilities and communication services rising 3.2% and 2.6%. However, the information technology sector led declines, falling a substantial 12.3%. US equities saw a late recovery but still closed the month lower. The S&P 500 fell 1.3% and the tech-heavy Nasdaq dropped 4%. Despite a solid earnings season, enthusiasm for AI shares waned. On the other hand, European equities responded positively to economic data and a potential end to the Ukraine war. The Euro 100 index gained 2.8% and the German DAX rallied 3.8%. The Hang Seng jumped 13.4% as investors poured capital into Chinese technology companies. Positive investor sentiment was driven by stronger earnings and a rare meeting between Chinese President Xi Jinping and tech executives. In commodities, gold continued to rise, closing 1.5% higher at $2,851 per ounce. The copper price rose 7.2%, while iron ore dipped 1.4%, and crude oil slipped 3% to $72.80 per barrel. Global bond markets produced solid gains despite rising concerns about inflationary impacts of tariffs. US bonds rallied as yields fell in line with softer US economic data. The US benchmark 10-year yield ended at 4.2%, 35 basis points lower. Australian bonds also gained as the Reserve Bank of Australia cut the cash rate. Speaking of the RBA, they reduced the cash rate by 25 basis points to 4.1%. The tone of the board's communications was more hawkish than anticipated, with Governor Bullock cautioning that market pricing of further rate cuts is too optimistic. The monthly consumer price reading for January came in at 2.5%, below the forecast of 2.6%. The strength of the labour market has continued to surprise positively, with employment rising by 44,000 in January. The domestic economic picture remains steady, with signs of improvement. In the US, preliminary Q4 GDP remained steady at 2.3%, supported by strong consumption trends. However, measures of US consumer confidence and sentiment contracted. The US Services PMI index showed an unexpected contraction, and PCE inflation matches expectations at 2.5%. Meanwhile, other developed markets such as the Eurozone and Japan have started to post positive economic surprises. Japanese GDP growth far exceeded expectations, and European sentiment data has shown improved positive momentum. Looking ahead, an unpredictable global backdrop is restraining expectations for the global economy. The US economic growth remains stable, but weakening consumer trends point to a more challenging environment. However, the developed markets, including Australia, are showing signs of improved economic growth. If you would like to review your investment strategy to ensure it aligns with your needs and objectives, please visit our website to schedule a meeting with myself or contact our office directly. That's it for today's Economic Snapshot. Until next time, we'll be watching.